Welcome to the eMortgage Management Hour, a straight talk show designed to give you the truth about mortgage financing in the greater Tampa Bay area. The views and opinions of your host, Scott Pendleton, and his guests do not necessarily reflect the views and opinions of WHNZ or its advertisers. And now, your host, Scott Pendleton.
How's everybody doing today? I am Scott Pendleton. eMortgage Management is a licensed mortgage banking firm, NMLS number 2926, and all of our contact information can be found at tampabay.emmloans.com. Today I'm excited because we're going to talk about a couple of different topics. We're going to talk a little bit in the first segment about the mortgage process, what you can expect when you're trying to obtain a mortgage. I'm going to talk also a little bit about some of the things I'm seeing out there from other advertisers and from a marketing standpoint that, to be honest with you, I feel is a little misleading. I also have a very exciting guest in our second segment today. I have Ben Older from Older, Lundy, and Alvarez, Family Law and Personal Injury. Ben's going to talk to us today about real estate and how it affects you if you're going, unfortunately, through a divorce, which it's more common than we'd like to admit. It's evil necessary sometimes, and a lot of times when you're going through that process, there is a real estate transaction or real estate involved. So we're going to discuss that process. Quick overview about eMortgage Management. We're a mortgage banking firm. We specialize in residential mortgages. We're not a bank. We really don't take deposits. We don't sell CDs. We don't do things of that nature. We're a mortgage banking firm focused on residential mortgages. We really focus a lot on the purchase market and refinance, and we are here to help you and educate you and be your advocate through that process. And as always, you can find us at tampabay.emmloans.com. You can also call us directly at the office at area code 813-517-0795. A little bit about myself. My name is Scott Pendleton. I've been a local mortgage banker here in the Tampa Bay area for about 16 years. Really enjoy what I do. I have a passion for educating consumers. Want to make sure that as we take the consumer through the mortgage process, we're available to answer their questions. We have a team of people. I have 2 full-time processors that work for me, and we really want to make sure that, our underwriting staff, to our processing staff, to our closers, really are there for you to make sure that we're doing the best job that we possibly can. I'm also a veteran of the United States Coast Guard, so I do have a special place in my heart working with veterans. We do quite a few VA loans in our office, and we're always happy to help our local vets and active duty military experience the dream of home ownership. As I have been doing this radio show now for a few months, I'm more sensitive or more focused on what I see out there in the market from other advertisers, other mortgage companies, when it relates to mortgage-related advertising. And I've been noticing a lot of what I'll call confusing information or even misleading or misinformation out there. I really do believe that the function or job of a mortgage banker is to educate the consumer and help them make an informed decision on the type of loan that is right for them. It's not my decision what kind of loan you use, whether it be an FHA, conventional VA loan. Obviously, you have to qualify for that loan product. But I really believe the mortgage banker's job or function is to make sure that we educate you as a consumer and you're making the right choice that's best for you financially in the long run. As I'm hearing these ads out there, I'm hearing a lot of mortgage companies I've seen it on television or I'm hearing it on the radio. I'm starting to hear companies tout or talk about low introductory mortgage rates. And what I'm hearing is, these rates sound really enticing and they sound really good, but what they're not talking about is these are introductory rates. These are rates that are really only good for the first year of the mortgage. Haven't heard anything like this in a while, but I'm starting to hear it on a couple of the local radio shows, and it makes me ask the question, what happens to that rate after the first year? They don't really talk about that. That's why it goes back to, something I talk about a lot when I do the radio show, making sure you're working with a true, trusted professional, making sure you're working with the right person, whether it be a realtor, an attorney, a mortgage banker, whatever the case may be, make sure you do your homework, do your due diligence, and make sure you're working with the right professional. It's very important. I'm also seeing ads for mortgage rates that seem lower than the average daily rate on what would typically be a 30-year fixed mortgage. And when you read the fine print, and I'm seeing these ads on television mostly, when you read the fine print, you see that they're adjustable rate mortgages. And this leads me to the question, not that an adjustable rate mortgage is a bad thing. It makes me ask the question, with fixed interest rates as low as they currently are, is an ARM the right choice for you as a consumer? And in some situations, that may be a yes. I can tell you right now, just ballparking based on rates the last couple of days, on a 30-year fixed FHA VA loan, rates are sub 4%, 3.625, 3.75%. That's 30-year fixed interest rates. Conventional loans with 15-year fixed interest rates as low as 3.5%, maybe even a little bit lower, 3.375. So, if you're a consumer, you have to ask yourself the question, is this a property that I'm going to stay in for a long, long period of time? And if the answer to that is yes, then you probably want to steer more towards the fixed rate mortgage. Now, if you're in a situation where you're here on a transfer and you're going to be moving in 3 to 5 years, then maybe doing a 5/1 ARM adjustable rate mortgage is a good fit for you. And what happens in that situation with a 5/1 ARM, the rate is fixed for the first 5 years, and after that, it can adjust on you up or down once a year moving forward. And with rates the way they've been over the last several years, a lot of adjustable rate mortgages have gone down. So I'm not saying an adjustable rate mortgage is a bad thing. You just have to make a decision if it's the right thing for you. I'm also noticing, I'm seeing a company, and I'm not going to name the company. I'm not here to disparage other companies, but I'm seeing a company that's spending a lot of money on television advertising their digital mortgage. You can do the whole mortgage online. And listen, we live in a day and age where technology is fantastic. I'm a big fan of technology. It makes my life a lot easier on a daily basis. But I also find that technology can be a deterrent to really good customer service. One of the things that I really preach in my office to my staff is that sometimes you got to step away from that email, step away from the computer, pick up the phone and call somebody. Let's have a conversation. Let's be clear. In today's day and age or market, pretty much all lenders offer some sort of online application. For example, if you go to tampabay.emmloans.com, you can do an online application right now. Fill out your entire loan application. I'll get a notification. I'll call you, and I'll look it over and let you know if or what you qualify for. We also have the ability for you to be able to e-sign, electronically sign, all your loan disclosures. So technically, you could do a whole loan with us with never really having a conversation with us. And we could take you through the whole process without ever meeting you. The problem with the digital loan, in my opinion, is the lack of service. I really pride myself, and I'm very proud of my staff on the way that we do things from a customer service basis. We all have the automated bells and whistles, but we also have a team of real people in our office with years of lending experience that are there to work for you. So, you have to make the decision if you want to do that digital, automated, no-touch, cold experience of a mortgage, or you want to have a conversation with somebody. We're here to answer your questions. There are a lot of pitfalls and scenarios that can cause a loan not to close or not close on time. It takes an experienced team of people to navigate you through those pitfalls. And when you start talking about a mortgage, there's a lot of people that are involved, or a lot of people that have their hands in every transaction. So as we go through the mortgage process with somebody, you have to realize from the time that you come to us and we pre-approve you for a mortgage, you're working with a realtor. Hopefully, in a timely manner, that realtor can go out and find you the right piece of property to purchase. Then that realtor probably is negotiating the deal with another realtor. The contract comes back to us, hopefully signed and accepted, and then we're going to start the mortgage process for you. And when we start the mortgage process for you, you're going to be dealing with that loan officer or mortgage banker like myself. You're going to be dealing with their processing staff. You're going to be dealing with an underwriter at the company. maybe not directly, but indirectly, you're going to be dealing with the underwriting staff. Then you're going to be dealing with the closing staff. And outside of that, you also have an appraiser that's involved, a survey company, a title company, a homeowner's insurance company. The list goes on and on and on. And let me tell you, throughout that process, if one person drops the ball or doesn't do their job correctly, those are the pitfalls that create those scenarios where your loans don't close on time. So what we try to do is really coordinate with those people to make sure that things are going well. Let's just use an example of down payment assistance. We talked about about a month or so ago, we talked with one of the local down payment assistance organizations. When you go and get down payment assistance through the city of Clearwater or Pasco County, it's great. You're getting some free money to help you buy a house, but somebody has to coordinate with the down payment assistance agency to make sure that if you are approved for that down payment assistance and you get that money, whether it be $5,000, $10,000, somebody's got to get those funds to the closing. Somebody has to coordinate all those things and make sure that those processes happen in a timely manner. So, that's just one example. And if you're doing a digital mortgage with a company, I don't know how you would be able to really facilitate those things. So you got to have somebody that you can call, kind of taking you through the process of a mortgage. As I take you through this process, some of these things will make sense to you, and you'll go, well, if I was doing a digital mortgage, who would I call for that? So let's talk about the mortgage process as a whole. So we talked about, going out and finding that real estate agent that you're working with. Hopefully, when you're going out and looking for a realtor, you're hiring a full-time professional, not somebody that's a part-time realtor. Make sure you work with a full-time professional realtor, somebody that's vetted, that you either get a nice, see some nice reviews on, or have been referred to. When you're working with that agent, obviously the first step before you go out and most good realtors are going to ask you to do this before they go out and show you houses. They want you to get pre-approved for a mortgage. Well, that's when you call us. Remember, my number is 813-517-0795, tampabay.emmloans.com. I'm here to get you pre-approved. I get you pre-approved. You go with your realtor. You find your dream home. It's the right house. It's the right price. Everything looks great. You sign your contract. Well, that's when we really go to work. We get you pre-approved. That's one step of the process. You find your property. When you get that contract signed and that realtor sends us that executed contract, that's when we go to work on the loan. And the process for us is really pretty basic, but as it goes along, there typically are several questions that come into play. So what happens is we're going to send out loan disclosures to you in the first, number one. We're going to send you out a list of loan disclosures, typically anywhere from 45 to 65 pages, and it's things like the loan application, Equal Credit Opportunity Act. We have to make sure that we have the proper disclosures. We got to disclose the proper fees that are associated with the loan. So once you sign all those loan disclosures, at that point in time, I need to gather all your income and asset information. I need all your W-2s, your tax returns, your pay stubs. I need to see your settlement agreement if you were divorced in the last several years, because there's a lot of things in that settlement agreement that we're going to talk with Ben here in just a little bit that we need to be able to understand how that the dissolution of marriage happened. So we're going to gather all this documentation. The first thing that we typically do in our office, we gather all that documentation. We go through it, make sure it all looks right, but then we hand it off to a processor. And our processors in our office, they're going to pre-scrub the file. They're going to look through that file and make sure that the information in there is really what we need. For example, we're going to double-check and read through those bank statements. We want to make sure that those bank statements, if there are large deposits on those bank statements, we have to be able to source where that money came from. And a lot of people don't understand that process. We have something, post 9/11 called the Patriot Act, anti-money laundering laws. We have to be able to source where large deposits are coming from. So you as a buyer, you need to think about that. Now, you can get money from family as a gift, and that's perfectly acceptable. And of course, we know your payroll deposits. We can tell it's your company that's paying your salary. If you get a tax refund, we can see that it's coming from the federal government. So things like that are very easy for us to see. But when we see large cash deposits, we have to be able to source where that money's coming from. So we're going to pre-scrub that file. If we see insufficient funds or NSFs on your bank statements. Underwriters typically don't like that. They want to be confident that you pay your bills on time. So we gather all that documentation, we pre-scrub the file, and we're going to send you a list. Hey, Mr. or Mrs. Borrower, here's a couple of things that we need from you. Now, the first thing we try to do is we want to get that loan into underwriting as quickly as possible. And really that process is your loan goes into a system, a queue, let's say, and within typically 24 to 48 hours, an underwriter, a real person at our corporate office, is going to pick up that file, and they're going to underwrite it based on the guidelines for that loan program, whether it be FHA, VA, conventional loan. And they're going to make sure that you fit the criteria. Another thing that we do during the initial process or the pre-qualification process is we typically run your loans through an automated underwriting system. Fannie Mae has a system called Desktop Underwriter. We run your loan through this automated underwriting system, and it kicks us out an approval. And it says the loan's either approved or not approved. Typically, we get an approval if we're that far into the process. And it says, okay, we need to document this many years of income. If there's commission income, we need to document it that way, this way. It's complicated, but not really complicated. And at that point, the underwriter is going through the automated underwriting findings and making sure that we have the proper documentation in the file so that when the time comes, after months after the loan closes, we can sell the loan in the secondary market. That's really generally how mortgage companies make their money. They're selling these loans in the secondary market. So we underwrite your file. Once your file is underwritten by an underwriter, we typically issue, or that underwriter will issue, what's called a conditional approval. Now, that means, yes, your loan is approved with stipulations. The underwriter is saying your loan's approved, but I would like to see perhaps a updated pay stub. I noticed that there is a divorce, and I'm missing some pages from the divorce decree. I see that there's child support. Once again, they need to see the dissolution of marriage or the divorce decree that shows that the person is court ordered to pay that child support. There's an array of different things that could come up during the underwriting process. And at that point in time, we are going to send you a checklist. We're going to say, okay, Mr. and Mrs. Borrower, congratulations. We have a conditional approval on your loan. And here's what we need from you today or tomorrow. The quicker you can get us the things listed on that statement, the quicker we can get your loan back to the underwriter to clear those conditions. So whether it be, pages missing from a bank statement. So, for example, if you give us a bank statement and your bank statement says pages 1 through 8 and you only give us page 1 through 7 because page 8 is blank, well, guess what? An underwriter's not going to like that. They don't know that page 8 is blank, so they want to see all 8 pages. It's a very detailed process. It's a very forensic process from an underwriting standpoint. They are going through that documentation. They're not going to have conversations with you. They're never going to talk to you. They go through us to gather the proper documentation. Another thing you see a lot in the market these days that wasn't as common years ago is underwriters love and need letters of explanation regarding things. So, for example, when they're going through the file and they're looking over your credit history, maybe they see an address that's tied to your credit history that's not represented in the application, and there's no dates on the credit report. In that situation, an underwriter would request a letter of explanation regarding that address. And it could be as simple as, dear underwriter, or to whom it may concern, that was an address I lived at from 1999 to 2003. That's fine, but it's still something that we have to get in the file. And a lot of times we have to go back and ask these things of the borrowers. And we understand it can be very frustrating and very cumbersome, but it's important that we give the underwriter what they need. We attack a file from a less is more mentality. We want to give the underwriter all the information they need to approve the loan, but we don't want to give them extra. And the reason is, the more you give them, the more they can ask for. And as a processing and banking team are clearing those conditions, every time you give the underwriter something new, it's an opportunity for them to maybe ask for something else. Bank statements are a perfect example. If we need an updated bank statement, and we had your September, and now you give us your October statement, and there's a large deposit on the October statement, we're going to have to go back to you, unfortunately, and go, hey, Mr. Borrower, there's a large deposit. Now I need to know where this money came from. And if any of you have ever done a mortgage before, or if you've done one especially in the last couple of years, you know how that process can get very, very frustrating because we're going back and forth, back and forth. Our goal is to clear those stipulations as quickly as we possibly can. And then what happens from that point is once we clear all those conditions, the underwriter will issue a final approval, or what you hear in the industry is clear to close. What that means is we're clear to move to the closing department. That's kind of the magic term. That's the verbiage that every loan or mortgage originator out there wants to hear. Every mortgage banker loves the words cleared to close. Once we get that, that means now we can schedule your loan with our closing department. And let me tell you, going from conditionally approved to clear to close could take a day. It could take weeks, depending on your personal situation. No loan is exactly the same. So we have to treat every loan as it stands and treat it on its merits. So once we do issue that clear to close or get that final approval, now we can schedule with the closing department. And on our end, there's some things that we need to provide for the closer. And sometimes there are funding conditions. That means the underwriter said, hey, your loan looks great. We've verified this much in assets. Let's say it's $5,000 that you have to come to closing with, or $10,000, whatever the number may be. So a lot of times they'll make that a funding condition. Your cash to close cannot exceed that amount. And that's why it becomes very important that the communication, back to not a digital loan, you're working with real people, that the communication is happening throughout the loan process. You've got to really make sure that you are diligently working with your team of realtors, mortgage bankers, and that we are diligently working with the realtors, the title company, and everybody else involved in the loan to make sure that the proper documentation is there. We've got to have that survey done at closing. And if somebody misses it, which happens sometimes, this is something that I've seen happen, periodically over the years. Typically the title company will order the survey. Well, if they forget to order it, and for whatever reason, maybe we didn't order it or didn't remind them to order it, now we've got our clear to close or our final approval. We're ready to go to the closing table, and everybody's going, where's the survey? Well, that's a big deal. Survey might take 3 or 4 days to get. You're planning on closing on Friday. Maybe we got our clear to close on Tuesday or Wednesday. If we don't have a survey, your closing on Friday might get pushed to Tuesday or Wednesday and next week because now we got to wait for a survey company to go out. So, it baffles me how you could do that through a digital process without people getting on the phone, emailing, talking, communicating throughout the process. And what this really boils down to is communication. Now, once the loan's closed, hopefully everybody's really happy. We're all shaking hands and everybody's good. We're going to walk away from the closing table with smiles on our face. And most mortgage companies, within a month or two after that closing is going to sell that loan off. And you're going to get a letter that says, hey, we're selling your loan. Goodbye. And your new servicing company is going to be sending you a letter, and you'll get a letter from a company say, hey, we're servicing your loan. And that's fine. They can never change the terms of your loan. That loan is what it is. If your rate's 4%, it's always going to be 4% unless it's an adjustable rate mortgage. It could change down the road. But, if a 30-year fixed mortgage is locked at 4%, they can never change the terms of your loan. And a lot of times people ask me, well, I know they can't change the terms of the loan, but sometimes I'm noticing that my mortgage payment is changing. Well, that's because most people escrow their taxes and homeowners insurance into their mortgage payment, and that can change on a yearly basis. So there's always that chance that your property taxes are going to go up. It's rare that they go down, although with the downturn in the housing market, there were a few years there where we did see some property taxes going down. And of course your homeowner's insurance can change on a yearly basis as well. So I hope that gives you a little extra knowledge or kind of gives you an idea of what to expect through the mortgage process. Obviously, if you have any questions, you can always come to us. Find our information at tampabay.emmloans.com. You can also call us at 813-517-0795. We're about to head to a break, and when we come back, we're going to talk to Ben Older from Older, Lundy, and Alvarez.
And now, back to the eMortgage Management Hour and your host, Scott Pendleton.
Welcome back. So for the second segment today, I'm really excited to have Ben Older with Older, Lundy, and Alvarez, Family Law and Personal Injury. Ben is one of the founding partners. Ben and I actually kind of got to know each other recently through a facility that we work out together. We did a very, very difficult workout one day. We were sweating profusely and sucking wind, and we got to talk a little bit after cooling off. We just both happen to do CrossFit. We work out at a great facility. I'm going to give a little shout out to TNL Tampa, the Next Level, or CrossFit Tampa. Great organization over in the West Chase area. Great CrossFit facility. They also do some boot camps. If you're into that kind of thing, call the group over there. Eric Stratman, the owner, is a good personal friend of mine. I've known him for a long time. And they do a great job. They got some of the best trainers in the market. So if you're looking for a great workout, we talk here a lot about fiscal fitness when we talk about mortgages and money, and we have different people in. But physical fitness, I believe, is just as important. You want to keep your body sound, and the group at TNL Tampa or CrossFit Tampa do a great job doing that. So with that being said, we've got Ben Older with Older, Lundy, and Alvarez, Family Law and Personal Injury. You can find them at www.olaw.com. I'm going to have Ben kind of chime in here and tell us a little bit about himself. So, Ben, welcome to the show.
Hey, Scott. Thanks for having me. I really appreciate it. Are we going to talk about divorce and mortgages, or are we going to talk about physical fitness? Because either one I'm fine with.
We could talk about physical fitness probably all day long. Nobody likes talking about their workouts and what they do more than CrossFitters. Right, I'm sure you've seen all the silly things on Facebook. CrossFitters love to tell you about their workouts. But today we're going to skip that. We're going to talk about divorce and law. We're going to talk about the mortgage process, real estate involved in divorce. But first, tell us about you.
All right. My name is Benjamin Older. I go by Ben. I'm an attorney, and I'm one of the founding partners of Older, Lundy, and Alvarez, attorneys at law. We handle marital and family issues, personal injury issues largely. I've been doing this since 2003. My particular area of practice has been marital and family law for the majority of my tenure as a practicing attorney in Tampa. We have about 9 lawyers, I think it's up to 9 now, that do only marital and family law, which is uncommon in the state. It's usually a much smaller group, but we're fairly large, and we handle all level of cases, giant multi-millionaire cases, small modifications, and everything in between. So that's really the basis of who we are and what we do, what I do.
Great. That's fantastic. So if somebody is, unfortunately, going through a divorce or thinking about going through a divorce, whether they be a millionaire or just a local guy, that works maybe, a blue-collar job, you can help them at your firm.
Correct. For the purposes of today's topic, and when it comes to real estate, the only time it's going to be relevant is going to be in a divorce case. But as a family law practice, we do handle paternity issues, child custody issues, and the like. But you're never going to have those issues per se related to real estate, because we're going to talk about equitable distribution in a minute, but really in divorce is when you're going to see the real estate issues become salient.
Gotcha. And we'll talk about that in a minute, but just so I understand, and so the people out there understand, for somebody that maybe they're not married, but there's a children involved.
Correct.
So you can help them with those type of issues as well.
Absolutely.
Okay, good. That's good to know. So let's talk a little bit about, listen, unfortunately, we know that probably 50% or more of the people out there that are married are probably going to end up divorced. That's kind of, the statistics I see are 54% of marriages end up in divorce.
That's what they say.
So they say, whoever they are.
Whoever the they is.
Right. A lot of times when you're going through divorce, there's real estate involved. When you have a piece of real estate, most people have a mortgage on that. A lot of people pay cash these days, but, a lot of times there's a mortgage involved. So my question to you is, what happens to real estate during a pending divorce?
Okay. Well, it's a fairly short answer to that, but a lot of people ask that question, so I definitely wanted to touch on that today. During a divorce, nothing happens with your real estate as a general proposition, as far as liquidating, selling, changing, et cetera, et cetera. Most oftentimes what happens with the real estate is one party stays in the real estate unless the parties are not can get along. In which case, if they can get along, they can stay in the house together. If they can't get along, usually one person moves out. And we'll touch on this too, I believe, is that person will typically not purchase another piece of real estate. Will usually rent something in the interim. The person that stays in the property, there will be some arrangement as to how, if there's a mortgage, how it will be covered, how the home expenses will be covered, how the anything related to maintenance, et cetera, will be covered during the pendency. And as a general rule, the courts frown on anything, any modification to the real estate holdings during the pendency because it just complicates things at the end of the case. The caveat to that is the parties are free to stipulate to do anything they want. So one of the things that I see a lot of time in cases where the house is going to go, meaning it's going to be liquidated because it could be mandatory given their financial situation, or it could just be that the parties are like, look, I don't want to keep this house. We don't want to keep this house. We're going to liquidate it anyway. So a lot of times the parties will stipulate and they'll say, tell you what, let's put it on the market. Let's sell it. We don't have to know what we're going to do with the money at the end. Let's just sell it. We'll put the money in somebody's trust account. We can either put it in one of the lawyer's trust account or we can leave it with the title agent, although generally speaking, the escrow agents don't want to touch any of that. They want it out of their – they want to take their money and leave.
Right.
But typically what will happen, and I have this going on in a few cases right now, is once the house sells, all the money, the net money, will go to one lawyer's trust account, and there'll be an agreement that says that money just sits there untouched until further order of the court or further agreement by the parties.
Right.
So that's one scenario. The other scenario is during a dissolution of marriage, if one of the parties feels that the house should be liquidated and the other party doesn't want to liquidate it, you can go and petition the court to have either the house sold during the pendency and ask for the money to be put into an escrow account and ask the court to order it, or you can do something which is similar, which is called a partial interim distribution, whereby you go to the court and you say, court, judge, please sell this property and actually distribute the money to the parties to be used in any way they see fit, so to speak, meaning we don't want to wait till later. I want my money now, and give that other person their money as well. So those are really the general scenarios.
All right. And listen, I'm a mortgage banker, right? So my mentality is, I would love to see everybody, one person keep the house and come to me and refinance, right? That's my perfect world. But I'll be honest with you. I think probably the smart move in most divorce situations is to liquidate the property. You have to ask that question when you're going through divorce. If I were single, which you're going to be real soon, would you buy that house?
Right.
Right. I know in my situation, the house that I live in right now, if, God forbid, after 17 years...
Never going to happen.
After 17 years of wedded bliss.
You listening, honey? Never going to happen.
My wife decided to finally get rid of my knucklehead self. The house that we live in now, although I love it, I love our neighborhood, I love our community, as a single guy, that's not where I'd want to be, right? Mm-hmm. So you got to ask that question yourself. So, that kind of leads me to a question, and I think I know the answer to this, but I'm interested in your take on it. Can somebody buy or sell real estate during their divorce?
The technical answer is yes.
Okay.
Okay, but the smart answer is no. I mean, when you're in the middle of a divorce situation, whether or not you're getting along and you're working towards a settlement, or whether or not, or you're in active litigation and, it's the War of the Roses, so to speak, it really just muddies the water to add any sort of significant addition to the portfolio, okay? Now, I could get into the technicalities as to why you can or why you can't, or where you draw a line in the sand for what becomes a marital versus a non-marital asset. I'm going to skip all that for a minute, and I'm just going to say this. There are very blurry lines with respect to whose money is whose during the dissolution process, right? Because it's going to get divided at some point, but there's question marks about how it's going to happen. And if it hasn't happened yet, money's got to come from somewhere. I mean, in your first segment, you're talking about sourcing funds, right? And where the money's going to come from and where it is. Well, it's a similar issue. where did the money come to put the down payment on this property? So you could end up in the untenable situation of, hey, I've got this new property. Now I'm locked into a 30-year fixed or a 15-year or variable, whatever the product is. And now I got to account to my soon-to-be ex-spouse about it. It's a problem.
Yeah.
All right. So you really want to avoid that. That's why I tell all my clients, and it happens, they say it's a great deal. They want to do the deal. They got to do it right now. It's the best thing ever. It's 1.2%, and I say I don't care what the deal is. Right. Just suck it up. Rent someplace for now. Don't muddy the waters. You'll have plenty of opportunities later, and I can find a guy like you or you in particular to help hook them up when it's time.
Right. And I get these scenarios that come to me. I deal with a lot of clients. I have these scenarios come to me all the time, and I'll take people through the application process. And when I hear that I'm going through a divorce, and somebody saying, "Well, I want to get I'm in the process of going through a divorce." At that point, I have to stop and really explain to that person or have a conversation with them. They need to really understand in the state of Florida, where what's considered a spousal state, you technically cannot purchase an owner-occupied piece of property in the state of Florida without your spouse
on the mortgage. Yeah.
You have to. So the question becomes, you're going through a divorce. Like you said, do you want to muddy the waters? Trust me, I make money closing loans, and I want to do, mortgage transactions. But I'm not going to put somebody into a bad situation.
Right.
And, it's, that's exact scenario. Well, I found this house. I love this place. It's such a great deal. I understand. It's a great deal. There'll be another great deal 6 months from now or 3 months from now. And I understand these mortgages. I mean, I'm sure you see it all the time. I've never been involved in a divorce. They could take a long time.
Yeah, of course.
So, it can be a little bit frustrating. I've got a friend that's going through a similar scenario. He's calling me about these properties all the time, and I have to keep telling him, hey, you're not divorced yet.
Stop looking at properties.
Stop. That's exactly.
And you'll stop finding properties.
He's working with a realtor that I'm a good friend with. I'm doing his mortgage. I've known the guy for a long time. I'm like, stop. You're going to drive yourself crazy. Stop looking at real estate. Stop thinking. Go rent for a little while. They finally got they're selling the marital house. They're going to split the assets, or however the court's deciding they're going to split the assets. You go rent for a while. When your divorce is final, come talk to me.
Right.
Let's slow down. Let's slow down. So, kind of back to that topic. What when you're calculating marital or non-marital interest of real estate for divorce, how does that work?
All right. So we're talking about at the end of a case when we're coming to either a final settlement or a final adjudication by a judge. Is that what you're talking about?
Yeah.
Okay.
We're getting to the end now.
All right, we're getting to the end. And again, this can either be pursuant to a settlement, the parties are agreeing upon something, or that a judge makes their agreement for them. And I use that term tongue-in-cheek because judges don't make agreements for you. Judges tell you what's going to go down, and that's the way it's going to go down. So let me wax poetic for one brief moment and just say that if you're involved in a divorce litigation and you can find your way to make an agreement that you may not love but you can live with, you're better off making that deal than letting a judge who doesn't know you, doesn't know your kids, doesn't know your personal situation, has only a few hours, whether it's 3 days of a few hours or 4 hours in a row, to learn your situation and rule about how the rest of your life is going to be.
Makes sense.
Okay, so I just want to say that, get it out there, because it's, everyone wants to, they come to my office wanting to win, and the first thing I tell them is there's no winning. There's only getting through it. And I make my money litigating, right? The more fighting there is, the better I do. But just like you said about wanting to sell mortgages, I would rather my clients keep their money, put it towards their kids, put it towards their retirement, and get through the process quicker and less painlessly than spend it all on a bunch of litigation and end up where they're going to be. Not to say I'm not equipped to do it, because we do it all day long, but just as my what I hope is sage advice to all my clients is try to find a resolution. So with that said, everything I'm about to say is either pursuant to an agreement or court order. Okay?
Okay.
All right. There are two types of definitions for a piece of real estate. And by the way, this goes for any sort of tangible asset in a dissolution. But we're going to just talk about real estate.
Okay.
There is a premarital asset, okay, which is also called sometimes a non-marital asset. And then there is a marital asset, okay? And now how that is defined with respect to real estate is if one of the parties owned the home prior to the marriage, that is a non-marital / premarital asset. Now, why does that matter? Well, like you said, especially in your world and the world we live in, most people are on a mortgage or on a note, I should say.
Yeah, the note's
right?
the note's the promise to pay.
The note's the promise to pay. We colloquially, many people call it the mortgage, but
right.
we all know we're referring to the note. Okay. They're paying on this note. Well, let's say they buy the house. I actually have this exact scenario. They buy the house a week before they get married, and one party buys it in their own name and keeps it in their own name. It's still non-marital. It doesn't matter if it was bought 10 years before, okay? Just so you know. But somebody buys it. It has a certain amount of value at the date of the marriage, but it was purchased before the marriage by one of the parties. During the marriage, they don't refi. They don't do quitclaim deed. They don't change the titling of the property. It stays exactly the same, but now they're paying on the mortgage. Well, once you get married, the dollars that you pay, I should say the dollars that you earn during the marriage become marital dollars. So I get married, I own the house. I never change the character of the house, so to speak. I never retitle it, etc. I start earning dollars in the marriage. 50 cents on every dollar is my wife's dollar.
Gotcha.
So every dollar I put into the into the note, if
right.
you will, every dollar I put into the note is half her dollar.
Yeah.
So the way the law treats that is they say, look, you can't ever, pursuant to a divorce, force the sale of that property. That you can't do. But you must account to the spouse for the appreciation that flows from the active participation in the growth and value of the property, which flows from the dollars that are put in during the marital dollars that are put in during the marriage, and also physical improvements. Like, let's say if you literally with your own two hands go and you build a garage onto it or do the roof, there's also a calculation for that. So the portion that would be attributed to the spouse who doesn't own the property is then the marital interest in the non-marital / premarital property.
I'm tracking you.
You tracking me?
I'm tracking you.
Okay. It can get really dry and annoying, but and I'm watching your eyes, because if you start to roll back in your head and snooze, I'm gonna have to change the way I'm explaining.
Okay.
But so far, you're wide awake. You're wide awake. Hopefully, everybody out there is wide awake too, and they're not flipping through the channels. But does that make sense?
It makes sense.
Okay,
it makes sense. So let's say we've made it through the process.
Okay,
we're divorced.
Correct.
What happens to the real estate then?
Okay. Now, the second part of that is the more standard scenario, or more similar, is you buy property during the marriage together. Okay. Generally speaking, without getting into details, it is going to be considered a marital property. The value is going to be divided. Either one spouse wants to buy the other one out and keep the property, okay, or it gets sold. The rub in this scenario is that a judge can order the sale of a marital piece of real estate. So while the judge does not have jurisdiction to order the sale of a non-marital piece, the judge can, if you end up at a final hearing and you guys can't decide what's going to happen, the judge can say, well, I'm putting this house in the courthouse steps. You guys, you want to be idiots about it? You want to settle? Fine. I'm going to sell it. You guys get what you get.
Okay.
And it happens.
Yeah, yeah. And the scenarios that we see on the mortgage side, obviously, if there's a sale of real estate, that's fine. Obviously, at that point in time, you take your proceeds from the sale, and if you want to go buy another piece of property, your divorce is final as long as you qualify. Let's hope that there wasn't any negative financial activity that happened during the divorce. Unfortunately, a lot of times when we're going through the application process, when we're dealing with people that have been through a divorce, the reality of it is a lot of time it has a very negative financial impact on you. It hurts your credit. It just does bad things. But let's say it doesn't. You sell that piece of property. Now you've got those funds. Obviously, you're through the divorce. You can go buy whatever you want.
Absolutely.
A lot of times we see those scenarios where one spouse does buy out the other spouse or wants to buy out the other spouse, and they make that agreement, and they say, you know what, and it'll typically state it in the marital agreement that one spouse gets the property. Right. Maybe the wife's going to stay there with the children. The husband's paying alimony, child support, whatever the case may be, and that one spouse keeps the property. But that husband, that doesn't have the property anymore, even though it states in the divorce that the spouse gets the property, he's still on that mortgage and note. A judge can't take him off of that.
No.
So at that point in time, typically what we see on our end is those settlement agreements state that, okay, other spouse that's keeping the property, now you have a time frame. A lot of times it's 6 months. You have a time frame. You need to refinance that property into your name, removing the other spouse, spouse A, from the mortgage and the note, relieving them of their liability to that property so that they can freely go purchase something else, because with that other debt, it may preclude them from qualifying. Now, there is a caveat to that in the mortgage world. If you show me a settlement agreement that says the other spouse got the property, then typically, I don't have to count that mortgage debt against you from an overall debt-to-income standpoint. You know, most of the lending guidelines make accommodation as long as it's court-ordered that you're no longer responsible for that property. I don't have to count that debt against you. Now, with that being said, just because I don't have to count the debt against you from a debt-to-income standpoint, if the spouse that got the property stops making the payments, those late payments are still going to show up and destroy your credit.
Right.
So you want off of that property.
Of course.
You definitely want off of that property. Unfortunately, most divorces are not amicable. You know.
Right.
We know that.
Well, they may not start amicable, but a lot of times people burn out, and they do, and they finally decide, well, I really do want to settle this. And so, I mean, my hope is that they always come to some kind of resolution. But it's interesting you bring that up with respect to the components of a settlement agreement to refinance the property, because I have made a cottage industry of receiving cases from other lawyers that did, or pro se litigants. A pro se litigant is someone that represents themselves, where they come to me and say, well, my settlement agreement says that she's got to sell the house or refinance it, but then it doesn't say what happens if she doesn't.
Well, and back to that, that's the exact scenario that we see a lot of times. So the divorce is final. One spouse comes up and says, hey, I've got to refinance now. My divorce says I've got 6 months to refinance. Well, I think we all know what's happened over the last 7 years in the housing market. It's no secret, right? We saw a real bubble burst, and we saw a decrease in values. Let's say you bought that house in 2004, 2005 at the top of the market. Now you want to refinance it. What if you have negative equity in the house? If you're upside down,
right? You
can't get blood from a turnip. There may not be an avenue or a way for you to refinance that property, and unfortunately, in that situation, typically both parties are kind of stuck.
Right, and unless the court order provides a mechanism to dispose of the property in the event that the party can't refinance, then you could really have a problem in resolving it. Because I literally got this phone call today from a potential client. I'm calling on my mom's behalf. She got divorced 5 years ago, and they made an agreement that he was going to refi the property. And the bottom line is they can't undo this deal and force the court to say now you got to sell it because it just says refinance. So you really got to pay attention to what's in the settlement agreements, because they can be problematic in the future.
Yeah. So listen, we're running out of time today. I'm sure Ben and I could probably go for another full hour.
Let's stay and talk.
Yeah. Well, unfortunately, it doesn't quite work that way.
All right. Fine.
So we're going to have to sign off here in just a few minutes. So number one, I want to thank Ben with Older, Lundy, and Alvarez Family Law and Personal Injury for coming out and talking to us today. OLAlaw.com. You can also find us at tampabay.emmloans.com. Really enjoyed being here today. Always enjoy our conversations. Always enjoy educating you guys. So thanks a lot for listening, and we'll be back next week to do it again.
Thanks, Scott.
You've been listening to the eMortgage Management Hour every Sunday at 11 a.m. on 1250 WHNZ. If you'd like to contact Scott Pendleton, you can call him at his office weekdays at 813-517-0795. That's 813-517-0795. Or for more information about eMortgage Management, click on tampabay.emmloans.com. Thank you for listening.